It looks like Alibaba might really be facing a future of being split apart. The Wall Street Journal reported on March 16th that Beijing authorities have been investigating Alibaba's media possessions since earlier this year and are shocked by its rapid and wide expansion in the media field. They have asked Alibaba to sell some of its media assets, such as the South China Morning Post, because its ability to influence public opinion is posing a huge obstacle to the CCP and its propaganda system. The authorities said, "We must firmly grasp the initiative and leadership of news media, firmly prevent the dilution of the party's leadership in the name of integration and development, and firmly guard against the risk of capital manipulation of public opinion." When Phoenix News Media reposted the article, it linked these words directly to Alibaba founder Jack Ma. If we follow this path of logic, we can see that the authorities' main goal with Alibaba's divestiture is to prevent it from conducting cross-industry integration. Alibaba's business is divided into several major fields. First, the online retail platform, which was the business it started with. To support this platform, there of course has to be funding and materialistic support, so Alibaba developed online payment and logistics, which considerably changed the traditional shopping experience. Then online payment led to personal and institutional online accounts with deposits and balances. As the number of customers grew, it eventually evolved into online banking. Through this bifurcation, complex financial businesses were derived. Until this point, Alibaba was always experiencing organic growth as it expanded within its industry. Then the next step for Alibaba is to cross industries. Alibaba expanded its business to media and entertainment. In terms of entertainment, Jack Ma invested heavily in both the traditional film industry and online video platforms. The Hong Kong-listed company Alibaba Pictures Group relies on the Chinese market and actively participates in Hollywood production investment. It had a good start in the film industry, immediately occupying significant market share. In terms of online entertainment, Alibaba fully acquired Youku and Tudou after they merged into video hosting service Youku Tudou Inc. in 2015. When it came to the media industry, Alibaba showed even more ambition. Despite being cross-industry developments, entertainment and media are built on the basis of the advantages accumulated from years of Alibaba's e-commerce services. Their large big data analysis system is able to analyze e-commerce users' shopping and viewing history before promoting new product information or videos and news to online audiences. Jack Ma may have appeared on the surface to be entering an unfamiliar field, but everything was actually deeply connected. This is called deep integration, a relatively high-level mode of expansion. It's not simply splurging money to buy a company. The final goal is to create an Alibaba-centric system with extensive control over society. This is the characteristic of digital power. It looks like Ma is controlling companies through equity relationships, but in reality, they're directly controlling individuals. Alibaba's main power lies in its powerful data collection and analysis systems that then feed information back to individuals, affecting people's daily habits. Buying these companies is simply an extension of its data capabilities into online videos, news, and so on. That's why the Chinese Communist Party is very wary of technology giants like Jack Ma and Pony Ma. The CCP relies on their technical ability to develop big data, while at the same time it has to beware of their expanding influence and deepening control over society. The idea of splitting up Alibaba seems to be to separate its businesses in these major areas, leaving the company with only its original e-commerce business. It might also get to keep Alipay, but other financial, entertainment, and media businesses may gradually be split up. But Alibaba's core, its ability to collect and analyze big data, that's what links every branch of the Alibaba empire together. It can't be split, but only taken over. If things keep going down this road, in the end it'll come to a takeover. This is completely beyond the experience of the CCP, of Xi Jinping, and of Jack Ma. And whether Pony Ma will be treated the same way as Jack Ma remains to be seen. The CCP and these tech giants can only play things by ear. The Wall Street Journal cited some of Alibaba's media holdings, which were quite impressive. It owns 100% of the English-language Hong Kong-based South China Morning Post, nearly 37% of Yitai Media Group, one of the most influential news organizations in China, about 30% of Weibo, worth more than $3.5 billion, a 6.7% share worth $2.6 billion of Bilibili, a popular video platform for young Chinese people, and a 5% stake worth about $819 million of Mango Excellent Media, a subsidiary of the government-run Hunan TV. These are all either top-tier Chinese media or media platforms. With Alibaba's holdings valued at over $8 billion, the company does have a very strong ability to intervene in people's thinking. Here we need to look at the word monopoly. Nowadays, monopoly seems to be synonymous with evil, something absolutely harmful to consumers. For example, if there's only one barbershop in a city and all other barbershops have shut down, then everyone in the city will have no choice but to go to that one barbershop. As time goes on, not only do they start charging more and more for haircuts, but the waiting time gets longer while the haircuts themselves get uglier. But there's another way to see this issue. A monopoly formed in a free market doesn't hurt consumers. Why? Because in order to prevent other competitors from entering the market, the monopoly has a strong incentive to lower the price of their product, so low that the only way it can make money is by relying on the size advantage of the monopoly. It then becomes unprofitable for any other business to compete. In that case, it would be beneficial to consumers who could enjoy steadily low prices. What happens if the quality of the service or product worsens once the price drops? Then competitors will take over the part of the market where consumers have high consumption rates and care more about quality than price. If the monopolist wants to maintain its position, it has to cater to the needs of this consumer population. Is there any evidence for this natural monopoly harmlessness theory? There is. The Standard Oil Company, founded by Rockefeller, is a good example. In 1890, Standard Oil owned 95% of oil refining capacity, 90% of oil transportation capacity, and 25% of crude oil production capacity in the U.S. It really was a monopoly in the oil industry. But it also kept kerosene prices low for a long time. In the 40 years from 1870 until it split into 34 separate companies in 1910, Standard Oil had been using a low-price strategy to crowd out competitors, and consumers enjoyed decades of low prices. Another story is that of a giant Walmart in a small city of 100,000 in New York State. It monopolized the supermarket business in the small city. In order to achieve this, it had to have not only a complete range of goods so that people could buy anything they needed in this one store, but also low prices that match the consumption level of the local population. Of course, local consumers benefited from the convenience. Therefore, naturally formed monopolies aren't necessarily harmful. But there's a prerequisite for this natural monopoly harmlessness theory. It has to be based on free competition. If one supermarket is out of stock or has high prices, there will immediately be other competitors jumping in to take over the market. In other words, competitors have to keep a close eye on the monopolist so that it has to rely on market strategies such as keeping prices low or providing better services and higher qualities to push out competitors. Once a monopoly gains coercive powers beyond the market, it'll become very harmful. For example, if one supermarket takes up the largest lot in the area and then persuades the local government to raise the limit for the number of parking spaces allowed in a lot, then it's impossible for others to open a store of the same scale to compete. When prices get higher and service gets worse but consumers have nowhere else to go, then it becomes harmful competition. Take the state monopolization of salt and iron in ancient China as an example, which was an even stronger administrative monopoly. The private sale of these two commodities was considered a crime, and competition was prevented with penalties. Only one company could sell the products, resulting in expensive products with worsening quality. Naturally formed monopolies aren't always harmless. When one capitalist holds both the upstream and downstream of an industry, they will have stronger bargaining power to lower wages and hurt workers and consumers. It also then becomes easy to turn to political pursuits and thereby perpetuate one's vested interests. The point here is that whether monopolies are beneficial or harmful depends on each individual situation. Not every monopoly is harmful. However, there are several kinds of monopolies that must be opposed. One is the monopoly of state power, where competitors can be jailed without rules or laws, so that there's no chance of competition at all. Not only does competition become impossible, but anyone who supports the competitor, and even those who don't support the competitor but express any different opinion, also become guilty. This kind of monopoly is definitely not what we want. There's another type of monopoly that isn't as scary but still goes beyond the market. Take the supermarket again as an example. A supermarket is harmless if it uses price and convenience to exclude competitors, but it would be extremely harmful if it binds itself to patriotism and stigmatizes its competitors. This is also considered to be power beyond the market. In the long run, these tech giants really are developing beyond market powers, such as providing customized information to users over long periods of time, deliberately culturing identical opinions, and imperceptibly engaging in long-term conceptual implantation and subtle brainwashing. All of these are developing powers beyond the market. The process might be mild and quiet without any violence, but it's still very dangerous. It's also difficult to clearly distinguish between market power and the political and cultural powers that go beyond the market. But tech giants today have already mastered the ability to infiltrate people's minds and manipulate people's judgment. This can be seen from their influence over the masses during the US elections. Ironically, in China, the totalitarian CCP regime, with its monopolized state powers, is using all its power to go against a tech giant over anti-monopoly issues. These tech giants haven't really even come up with any ideologies. Their ability to simply influence public opinion is already enough to make Xi Jinping uneasy. So it's really not surprising that Alibaba is facing the possibility of being torn apart under the CCP's rule.